Good evening. I'll be talking tonight on international trade finance, and we are looking at the international trade finance. We're looking at the types, also benefits, and also how it works. So, when we're talking about international trade, we're talking about it's an exchange uh, involving a goods and service conducted between at least two different countries. That is an exchange. Can also be imported or export. And import refer to a goods as a service also brought into the domestic market, and export refer to a goods or service sold to a foreign country. So international trade is a method of economics or interaction between international entities, uh, and is also an example of economic leakage. Other forms of economic leakage include foreign financial investment, multinational corporation, and also foreign employees. The growth in this form of economic leakage is known as the globalization. And so we say international trade is an exchange of goods and services involving at least two different countries, and also looking at comparative advantage allows for gain from also international trade, ultimate also leading to increased also consumptions of goods. So two major protectionist trade policies are also tariff and also import uh, of quotas. So why looking at why international trade occur? International trade occur because one country enjoys a comparative advantage in the production of a certain good or services or service, specifically of the opportunity cost of producing that good or service is lower for the country than any other country. If a country opts not to trade with other countries, it is also considered to be and also an anarchy. Turkey. If we also consider a two countries model, both countries can also gain from specialization and trade specialization, and trade with all will allow each country to produce the products they possess a comparative advantage in, and also then trade and the ultimate consumer more consume more of both goods and service. So therefore, there are also gain from the trade. There are gain from the trade. We're looking at different gain from the trade, and also, but before we look at that, we're looking at source of comparative advantage. Number one, international difference in climate. Our climates are quite different to each other. There are some climates that is pleasant to some crops, and some are not pleasant. Like we talk about cocoa, I mean cocoa in the south Nigeria is they are doing very fine, or in the west Nigeria they are doing very fine. In other countries, it's not doing so. They are also the climate issue. For example, um, apple does not grow that much in Nigeria, but we import them to Nigeria because of the climate. Number two, difference in factors endowment. Everybody has what they have. They have. Some people are very rich in other very rich in land and labor capital, and also on also human capital, according to um, Shaker model. A country enjoys a comparative advantage in also production of the resources are abundant in such countries. So we talk about that. Then difference in technology. Uh, the it's only African countries that are still low in technology, and overseas there are so much technologies that's aiding their production. We talk about the Japanese are able to produce more output with a given input than any other country. So we talk about that. And examples of international trade policy, we have a lot of trade policies. Number one is the tariff. Tariff is an excise that is paid on the sale of imported goods. Tariff are also put in place to discourage import and also protect all domestic production, and are also a source of government revenue. And we talk about number two, the import quotas. And import quota refer to a legal limit to the quantity of goods that can be imported to the country. There are other orders that we don't mention, and also argument for a protectionist trade policy. The three major arguments for a protectionist trade policy are national security, job creation, and so protection of infant industries. So, generally, we talk about this protection to all our industries so that they can new industry can also be formed. So, international trade is the exchange of capital goods and service across international border as tariff, as territories, also because there is a need or want of goods or services, and in that. So we're also looking at the characteristics of global trade. A product that is transferred or sold from a party in one country to a party in another country, is an export from the original country and also import to the country receiving that product. Imports and exports are also accounted for in a country uh, current account in the balance of payment. And so we're looking at trading. Trading globally may give also consumer and also the countries the opportunity to be also to be exposed to new markets and products. Almost every kind of a product can be found in the international market. For example, food, clothes, spare parts, oil, and so many things. So the Asian Silk road trade route also across the for Asia. So advanced technology including temporary transportation, globalization, industrialization, and also the outsourcing and the multinational corporation have also made a major impact on the international trade. So looking at different from domestic domestic trade. Domestic trade are the trade between within a country, within one country. That's what we call the domestic trade. That means Nigeria trading within Nigeria. And why we also have the international trade, which is trade principles are different from domestic trade as the motivation and the behavior of parties involved in a trade do not change fundamental regardless of whether trade or is across a border or not. However, we're moving on. I just want us to be doing something. Let's look at five reasons for international trade slash element. Five main reasons international trade take place. One, difference in technology. There's that the technological advancement in some countries, and they are doing very fine. Two, difference in resource endowment. Three, difference in demand. Four, the presence of economic of scale and the presence of a government policy. Each model of trade generally includes just one also motivation. And we're looking at eight benefits of international trade. There are so many benefits of international trade, and we're looking at the benefits. And one of the benefits of international trade is that the greater variation of goods are offered for consumption. So it's not just one goods, There's various goods. You can select what goods to eat and what not. So across the border. Number two, effectual allocation and healthy utilization of resources. There are some resources that are not known or buried, looking at the effectual allocation and also healthier utilization of it. Two, promote effectiveness in production. Because of the international trade, a lot of people want to produce more and have a good this thing. Then employment is another one that we need to know, that more international trade comes in, the more people are employed to work and do a good job. Then the next one is low price consumptions. Since there are competition between international trade and the domestic trade, there's a lot of low prices consumption, and one of the things is that the country has to put some restriction to it, or such country become a dumping ground for those things. Then the others reduce trade fluctuation. When there's international trade, life size market with huge supply and also wide demand. Foreign trade also lessen trade fluctuation. So the cost of goods have a tendency to also continue between more stable also there. Then utilization of extra produce. There's an utilization of extra produce when it comes to the issue of international trade. Then also we're talking about the nurture peace and goodwill. There's always peace and goodwill. I won't also uh, forget to also say a level of development and growth is another thing to really talk about. The level of development and growth is another area that we need to talk about, which is an advantage to international trade. So that is what we look at. Then this one, we're looking at the drawback of global trade. There's some drawbacks into it. Number one, exhaustion of vital resources. Many of the resources will be will be exhausted because the international trade. For example, the mineral resources goes up and resource may deplete due to international trade, and so it can affect the trade of your country. Then number two, has an impact on the domestic industries. Yeah, the international trade may negatively impact a country consumption habit because of the importation of frequent hazardous and cheap made goods. Number two, lopsided economic growth. International trade result in specialization and one-sided economic development due to comparative cost, which is not advantage for the this. When we talk about the lip-sided economic growth, that means the countries that have more resources to produce to live would also be growing also and affecting the other ones. Then we also look at the other one there is the so we are also looking at the uh, has an impact on the domestic industry because of the level of the level of resources that is bringing. It has impact on domestic industry. Then we talk about the loop-sided economic growth. The dangers of dumping. For example, some years ago, Nigeria was a dumping ground to any type of car, you know. But until the government made a law that nobody should bring a car that is above 10 years. And because there are times when I'm coming, I see some cars, and I'm like, how can this type of car come to Nigeria? But thank God for the government who quickly rescued the situation. And also, apart from that, the reliance on foreign countries. There are countries that cannot stand on their own any longer. They depend on other countries for a living. A country like Nigeria is one of them that imports virtually everything to toothpaste. Then number six, opposition to national defense. Now, if the market is not controlled and also the people are not controlled, it might bring a problem of defense to another country. And you need to understand that some multinationals are even are bigger than some countries, so they can control the everything about the country. Then seven is the economic planning and unpredictability is a cause of economic instability and obstruct national fundamental planning for growth and also development. The last is the legal also inconsistency, since each nation has a regulation governing special industry. It can be also difficult for multinational corporation to adapt to them. So the dispute resolution also process is also somewhat complicated. And nine, returning product. The system for returning product and process reform must be also in place because not all international customers will be pleased with a company's product. So there should be a way to refund to people who are not interested in what they do. Then 10, intellectual property theft. The product is more likely to be legally copied by a rivalry and more widely it is used confidentially. So there's theft of a trademark or product. Then language barrier. One of the biggest problem is the language barrier because they cannot speak. For example, I don't hear Latin, but today it has been made easy by the AI where I can talk to people. I can talk to a Chinese man who never hears English, and as I'm speaking, he's interpreting it to the Chinese man. So the issue of language barrier is already getting up. So the cultural difference is one very issue that needs to be tackled when we talk about the cultural difference. We have different cultures and different ways of life that we do them. So the nation has written trade customs and also that. Then we also look at the next one, which is we are looking at the next one, which is the customer services. The customer services is very important to us because every time the customers to create customer loyalty, customer friendly, or customers that would like your goods, then or in the foreign country, it's going to be a bit hard to have control over your customer. Then 14 is the barrier to home industries development, trade and also other countries halt domestic industry growth. It threatens the future of the development domestic industry. So the countries emerging also sectors risk failing due to the overseas competition and the unfettered export. Then also dependence on politics. Politics are not really straightforward. There are changes, frequent changes and enslavement, and also the trade frequency, trade international trade frequency promotes enslavement and also slavery threatens economic independence. Number 16, improper use of natural resources. There are countries that does not use their natural resources reasonable, like Nigeria. They can use it anyhow. 17, the predatory pricing. Foreign companies can readily establish themselves in other countries, local vendor also, and bring down the price of what they do to the country. And also 18, also the uh, overuse of natural resources. And natural resources are overused. Because Nigeria is playing with a lot of problem until the multinational frequency locate the business near water or in a natural also region. Then the last one there is that when there is a shortage of an item, some nation export massive also quantities of that goods to other countries. It has a also minimum amount of also the goods also an unanticipated increase in demand. We're looking at the types of international trade. The international trade has some types of this. We have the first one is the export trade. Export trade is when goods manufactured in a specific country is transferred or purchased by another country or sending one goods to Another place is we are exporting goods. For example, Nigeria exporting charcoal to to China and Japan. Two, the import trade. The import trade is the trade transaction that brings goods from other country to your country. You say you imported the goods. Then intraport trade, also known as the transshipment. Extra port is where goods are imported into a country and then re-exported out. That's the intraport. Then we are looking at the formula for balancing balance of payment. The formula for the balance of payment is balance of payment is equal to balance of current account plus the balance of financial account. Note that capital account is assumed to be a subgroup under the financial account. So the balance of payment with example, country A brings in goods worth 10 million and this an inflow to the country under the current account in exchange for the goods. So country A paid money to country B. This is an overflow of money under the financial account. So the balance of payment is zero with the two also accounts balancing each other. Then we're looking at the types of balance of payment. Well, when we talk about them, there are two main types of balance of payment. The first one is the current account, which is the comprise the inflow and outflow of the goods and asset. Then the second type is the financial account, which also comprise the inflow and the outflow of international money transaction. There is also a small subgroup under the financial account, and it's called and it's and that is the capital account. So the balance of payment that we have seen, the BOP is a statement of all transactions made between one country and other countries in the world. It's likely to checkbook, also register that show all the inflows and the outflow of money and the also imbalance out in equals zero. When we talk about the inflow and outflow, let me just put some little inflow is the amount of money that comes into organization, and why the outflow is the amount of money that goes into out of the organization. There are some organizations that have policy how much can be transferred from the organization into another. So we also have the what balance of payment and its important. So the balance of payment is the statement of inflow. I've explained that and outflow. So the balance of payment is important because it serves as a check and balance for the country stability, surplus or deficit. Also repairs more in-depth analysis to find ways to stabilize economy. So the balance of payment, the balance of payment is a term used in international trade for the statement of the transaction, also between one country and the others, which we have already said before. Then we move in on to uh, the balance of payment theoretically will equal zero because it is a construct according to the uh, double entry bookkeeping. So under the system, this system, any transaction is also represented in the B balance of payment by two entries in the accounting ledger, and these two entries have equal value on also the opposite side and the debit and also so the credit outflow of goods also service or stay absent in terms of assets and also liability. Also credit may also be differentiated as an increase in liability, an increase decrease in also the asset slash goods. So why we have the debit inflow of goods, service, and also asset in form of asset and liability. Debt may also be differentiated as a decrease in liability and also increase in also accounts through goods. So by conversation, every credit entry has a plus gain sign, and every debit also have a minus sign in it. So you can talk about the outflow and the inflow, and we see them there. I don't want to dwell there too much on that. and we can see outflow, the money, the car, and others there. But that is not really where I'm going. I want us to look at the balance of payment. So the balance of payment is a statement of all the transactions also between countries, one or two countries, which we have seen. And we are looking at the balance of trade and balance of payment. So definition, balance of trade or balance of trade is a financial also statement that also capture the national's import and export of commodities with the rest of the world. Why the balance of payment is a financial statement that keeps track of all the economic transaction by the also the nation with the rest of the world. Then what does it deal with? Under the balance of the trade, it deals with the net profit or loss that a country incur from the import and export of goods. Then B, under the balance of payment, it also deals with the prosper accounting of the, proper accounting of the transaction induced by the nation. And also the fundamental differences. One, balance of trade is the difference that is obtained from the export and the import of goods, while balance of payment is the difference between the inflow and the outflow of foreign exchange. Then looking at types of transaction include under the balance of payment, we say that the transactions related to goods are included in balance of trade, and also transaction related to trade to transfer goods and is on balance of payment. So capital transfer included, yes, under the balance of the trade is no, under the balance of payment, yes. So what is the net effect? Under the net effect of a balance of trade can be also either positive, negative, or zero, while under the balance of payment is always very zero. So the also above mentioned is the concept that is elucidated in also detail about the difference between the balance also of trade and balance of payment for commerce student. And so we say effects of international trade on the company. Countries also that are open to international trade tend to go faster, innovated, improve productivities, and also provide higher income also and more opportunity to the other people. So open trade also benefit lower income household by offering also consumer more affordable goods and also services. So the purpose of the international trade allow countries to expand their markets and also access goods and services that otherwise may not have been available domestically. As a result of international trade, the market is more competitive, then ultimately result in more competitive pricing and also bring a cheaper product home to the consumer. And so we are also looking at the international trade, and here we're looking at the international trade finance, meaning uh, the financial activities involved in global trade transactions, such as import and export of goods and services, are referred to as international trade finance. These finance activities can also include a varieties of tasks, such as financing, risk management, and also payment also procedure, etc. So global trade finance instruments are simply the financial help provided by banks or financial institutions in the frame of global trade through various types of financial instruments like bank guarantee, letters of credit. These varied varieties of financial instruments also produce uh, help importer and exporter to also excel. And so we're moving on, then we also look at the uh, it brings It bridges the gap between importers and exportation by doing a third party and covers uh, activities like insurance of a letter of credit, lending a forfeiting, and also the parties involved are also international trade and also financing involve multiple parties here, each with their own set of role and also responsibility. In the next class, we'll be looking at the most international trade finance transaction following the parties that are also involved. So thank you so much. We'll see that again in the next